Welcome to Align Spotlight, where you meet your manager. Hey Baird family, this is AMR's Jason Cooper, and welcome to Align Spotlight, where you meet your manager. We've got a special fixed income episode lined up, and it is my pleasure to introduce AMR's fixed income portfolio analyst, Joe Lorbird, who conducted this episode's interview. I hope that you'll stick around to hear Joe's thoughts on the benefits of using a go-anywhere, yield-oriented fund in constructing your clients' portfolios, and how we use it in Align. Take it away, Joe.
Thanks, Jason. Today we're joined by Rick Rieder, BlackRock's CIO, Global Fixed Income and Co-Portfolio Manager on BlackRock's Strategic Income Opportunities Fund. This fund has been on Baird's recommended mutual fund list since 2013 and added to the aligned strategic portfolios in 2014. Rick has been with BlackRock since 2009 and has been instrumental in shaping the firm's investment process and fixed income business. From BlackRock's office in New York, please welcome Rick Rieder.
So Rick, thank you so much for joining us today. Really can't tell you how excited we are to get you on the podcast. Really looking forward to our discussion, and so let's kind of jump right in. Thought we'd start with your background in early days at Lehman and R3 Capital Partners, and just looking to see if you can provide some color as to how that experience helped to shape you as a fixed income investor. And maybe more importantly, how did it help to develop you as a manager of risk across the fixed income space?
So I tell you, that is a hard question because you think about, still can't believe I'm doing this 35 years, I think is the number now. But it's hard to think about like everything in your life, like everything you do sort of builds to who you are, and you don't even think about it as it's happening. But I try to think about broadly. I mean, I will say one thing. My background is in credit, and I have to say, and I say this to people when I speak in groups all the time, understanding companies and understanding cash flow has been hugely helpful to me in thinking about big picture macro. So, I think it's developed into, I used to do credit calls similar to what we do monthly overall markets calls. And, it's amazing how it translates from credit, the building blocks of leverage, of what trades growth, why are companies doing capex or hiring or not. And I would say the first thing, being in credit and understanding cash flow, leverage, gearing, vol, and it was hugely important. I'd say the other thing that was hugely important, being on the sell side for a long time, 21 years on the sell side, I've seen so many clients of ours at the time, and I'm hopeful I've picked up some of the good traits and watched some pretty brilliant people out there. And I've always envied the, gosh, I like the way this firm does this or that firm does that. And I have to say I've picked up, and I've thanked some people, by the way, over the years that picked up some really good ideas for how people do it. And as you would imagine, some that I wouldn't do it that way. And so anyway, I think that was a big help. And then I would say a couple last things. One, you know, we are devout believers in research, and being on the sell side, the way we built our business, was in credit. I ran credit at Lehman. Was build your research platform, and that research drives everything that you do. And part of like the credit and research, bottoms up everything to get to a top down as opposed to start top down, because I don't think it works. But that research, and I think was critically important. If I can I say two other interesting things about that I was thinking about. One, I've seen a lot from the financial crisis to 9/11 to the emerging markets crisis. And there's a couple of things to take from all these things. One, I don't like selling tail risk. I don't, stuff happens. And unless you're getting paid and your portfolio is set up to absorb that tail risk, I think a lot of people write tail risk in multitudes of ways. And so the reason why I tend not to get way out there in terms of credit exposure, emerging market exposure, and downside options, stuff happens, I've certainly have seen that. And by the way, one of the things you gotta, I think I say this to people I work with, when you see a lot of bad stuff over the years, there's stuff that you're like, gosh, I wish that didn't happen. You make you risk averse. So one of the things is like balancing. You don't sell tail risk, but you still have to take risk to make money. And so trying to balance that. And I am tell you a 2-second funny story, and I promise my answers won't be this long. But I learned a lot. I went to University of Pennsylvania to Wharton for business school, And there was something that I have to tell you was I speak to when I speak to our analyst class or what have you, I tell this story. But I learned a lot about nuts and bolts of analysis and going into derivatives and credit and macro, et cetera. But I'll never forget this. So it's a presentation from a casino company. And it was Golden Nugget, which I think it's been absorbed into somebody today. And I'll never forget, so they asked the question, how do casinos make money? And everybody said, well, the odds are in your favor. And he said, actually, they're only moderately in our favor. I think slot machines maybe a bit more, but he says, they're only through the odds. But he said, you know what happens when people come to the casino? They bring $200 with them. And what happens is you go up, you go down, you go up, you go down, and then when you lose 200, you leave. We make money because people lose $200 and leave. And I can't tell you how much an impact that had on my thinking from day one. Not, please don't tell people that was the most impactful thing. But anyway, but what I thought about is, gosh, you don't want to ever get to you've lost 200, you're out. Yep. And markets oscillate back and forth. They mean revert many times. And this idea that, try and catch, buy low, sell high, as cliche as that is, but don't get out there like you can't. You got to make sure you never get the down 200 and you're out. And I think that was like a really big, and quite frankly, I see that in markets all the time. Is everybody wants to get to, I got to make this, so this is the risk I'm going to take, and then they've overdone it. So, and it was just sorry, that was the longest answer you've ever had. But anyway, if you ask somebody who's been doing this for so long, they keep going, I think.
No, that was perfect. Thank you. Yeah. So you usually experience of limit in R3, land on the doorstep of BlackRock, and there are clear advantages to BlackRock in terms of size, scale, resources at hand to really kind of generate and outperform relative to your benchmark and relative to your peers. And so I'd ask you, as CIO of global fixed income, what are some of those inherent advantages that make your job a bit easier? But maybe more importantly, what are some of the risks that come with that size and scale? And as a leader across the business, how are you looking to kind of stay proactive in mitigating some of those risks in today's environment as to kind of not getting too big where it kind of overcompensates your business and ability to outperform?
Yeah, I mean, I think one of the critical things for us is, we're devout, because of as you talked about, the research around the world and having boots on the ground in every region that allows us, that we don't have to start anew when we're thinking about, gosh, we're looking at an area, we're looking at Asian bank credit. Yeah, we have people that are experts in the space, and so we go to them, and we have experts in Asia, we have experts in bank, we have experts in credit. And so it really gives us a leg up, and you can be, particularly in things when you're unconstrained, we're not restricted by bias. We're a credit house or mortgage house, et cetera. And then we can really be agnostic to asset class and take advantage of the research, plus analytics, risk management, stress testing, scenario analysis. I mean, there's some really, really, great tools that we have access to that have made it, big advantage. And then the last thing I would say, particularly today, is information flow through the platform. There's been a real evolution over the years where, having been on the sell side for a long time, the things have evolved quite a bit, and that you see through the platform an incredible amount. I hear like, what do you think is going to happen? How insurance is going to do, what insurance is going to do, or pensions are going to do. When you see that internally, it gives you a really, really good perspective, not always right, but a really good perspective. And I think the one thing, though, that I will say, the thing you have to balance from time to time, sometimes when markets are one-sided or a new issue, everybody can go in at the same time. So sometimes being big that way is not perfect. But I think the other things, and hopefully, like I say, we don't always get it right at all. But the other benefits, I think, outweigh that. That's the one part that at times can be difficult. And then, I think about a lot as well, per the earlier part of the discussion, make sure, given our scale, make sure you're not getting too large in any one area at any point in time, because you always got to think about exit strategy. And, oftentimes we're buying when others are selling and vice versa. And, try and do that as effectively as you can, which isn't always, because the news flow is uneven. It's not always perfect in terms of executing that.
Okay, no, that's great. So maybe next, just hitting on, and maybe going back to your days at Wharton, essentially thinking about theory versus practice. and essentially thinking about what should happen in theory, is oftentimes very different than what actually happens across various different markets, right? So valuations disconnecting from fundamentals, technicals influencing, markets maybe more so than was anticipated, at some time deficits mattering, in an environment where unorthodox policy has become more orthodox every single day. Walk me through how you and your team are assessing the theory versus practice conundrum, and how important the need is to kind of drown out the noise across the industry and focus on the information that really truly adds value.
So, Joe, I would say I can talk about it in theory, and then I have to say it's not always easy to. I would say, you always, you're always drawn into the news of the day, and you're always drawn into, and by the way, the FOMO and other things that tend to pull you into things. So I know I don't speak as a as a necessarily perfect wisdom on this, but listen, I think the big thing for us is identify the regime you're operating in. I do these calls on the market, which try and do at least once a month, try and do a really big picture, take a step back, and get away from what's dollar yen doing, what are 2-year swap rates doing, and just think big picture, take a lot of data, a lot of graphs, and try and assimilate what's the regime you're operating in. Because if we get the regime right, then usually your asset allocation follows directly from that. And by the way, regime, starts from the bottoms up. When we see what's happening in the mortgage market or the financing market or repo market, et cetera, it builds, this whole framework for what is, your regime you're operating in. But the big thing for us is stick to the regime, and then you got to tweak it when, oftentimes you may be right, and I've learned over my career, it's not about being right. It's about anticipating what others are going to do, and I think it's a really big deal because we could come up with a conclusion on something, but if the data flow is going to be such that people are going to react differently, that's more important, quite frankly, for generating return. But start with what is the big picture regime you're operating in, and then try and be religious to that around where is risk reward the most efficient in that regime. And so go through periods like last year, and it was with the pandemic's coming, raise cash, raise cash. Then shift Fed's coming in, follow the Fed duration, high quality assets that had gotten banged up. Then they pulled real rates down, get down the cap stack, run more of a barbell, use some high yield parts of equity upside, et cetera. I think that's a big deal. Like we think we're in one now where real rates are going higher. So what do you do with that? You got to manage your risk around that. Think about where do you want to hold your risk. But it all, I say sometimes you lose your confidence around, maybe this is a signal we should be paying attention to. But we're pretty good about generally getting that regime right, sticking to it, and then tweaking around the edges and trying not to be distracted. And if anybody tells you they're not distracted, I think they're lying. So, but anyway, that is the core of how we're trying to operate it.
Yeah, so maybe just hitting on that point and thinking about how one can be distracted given the amount of information that is provided to market participants. You said in an interview a couple of years ago that information dissemination in today's environment is perfect. So many markets are becoming more homogeneous, and I'd love to get your take on the active passive debate in the fixed income space, and thinking about why an active strategy like SAO and the merits behind it, are valid relative to most passive fixed income vehicles in today's environment.
So, man, I think, the core of it is that I think there are parts of an index that are always inefficient, and if you're doing your job around risk reward efficiently, and you're picking out parts of an index that are effective versus not, there's always going to be points. Like today, the index is giving you tremendous amounts of duration risk, and the point in time where the economy is doing exceedingly well in a bounce back, just sitting in that index and capturing all that downside duration risk when there's a better strategy around, owning some credit assets, owning some securitized that have less duration, maybe having more your duration in Europe versus the U.S. Listen, there's been some pretty good data about Yeah, and I think maybe Hannah's going to go through some stuff that I think we've beaten the peer group every year except for the last 10 years, except for 2016, and with a much lower vol, so our Sharpe ratio is high. And I think we've beaten the index most years with about 40% of the volatility. And I think one of the things that I believe in is being unconstrained. It doesn't, it sounds like when people say you're unconstrained, it sounds like you're hanging from the chandeliers and doing like crazy stuff because I'm unconstrained. I actually think it's the exact opposite. I think being unconstrained means you have more tools at your disposal. And if you said, gosh, you can only do two things or you can do 10 things, I think you'd rather do the 10 things and just eliminate the ones that aren't efficient for you today. And by the way, there are years, like we underperform the ag in SIO when rates are coming down. The 3 years that rates dropped precipitously, we're never going to keep up. We stay pretty close. We generally stay pretty close. But years where rates are stable or rates move higher, we usually beat it by 100, like this year, we beat it by hundreds of basis points. Anyway, but the idea being, use all your tools available to you globally across sector, across parts of the cap stack, different parts of the yield curve, et cetera, and just do it. I believe in this theory. I call it make a little bit of money a lot of times, and find the best expressions. And this goes back. People think I'm obsessed with casinos, but I think part of how they make money is literally if you just make a little bit and used to it a billion times, it's a better strategy than hanging out there and saying, gosh, I'm going to bet big on the 10-year, that 10-year rates are going 40 basis points higher. I mean, we have views, we do think real rates are going a bit higher, but if you put all your eggs in that basket, I don't think that's that, and today that, many of the indices are exactly that.
Perfect. Yeah, no, that's a great point and well taken. Maybe that's a good transition into thinking about BlackRock's and your team's approach to risk management, and thinking about just how important position sizing is, portfolio construction, scenario analysis, stress testing, and making sure that the portfolio is never getting to that 200 and out environment. So love if you can hit on risk management, maybe the Align platform and how you're leveraging certain tools within kind of the BlackRock ecosystem to ensure that risk isn't necessarily being taken egregiously.
Great, and I'm laughing because it's a funny point in time. So we have these dashboards that Hannah and her team we are religious about, where it shows all the different expressions. It is this unbelievably large spreadsheet. And the reason why I'm laughing is I just bought a new printer because I'm tired of going to the UPS store and printing it out every weekend. And literally every week, and I have it spread out on my living room floor. So I went and bought a printer, and of course it didn't work. But anyway, but these dashboards, the reason why I say that is these dashboards, allow us to cut all our risk in different cells and rows and think about how much dispersion risk you have, meaning how much what hedge funds call VAR risk. How much are you gonna, or are you gonna create real dispersion in the portfolio? Second thing is we look at something called risk on, which is the beta. Like, are you just running beta risk? Because people can just buy a high yield fund or buy an equity fund if you're running beta. How much liquidity risk do you have? We break every single asset into tier 1, 2, 3, tier 4 liquidity, because you don't want to sit there with a load of really illiquid assets clipping yield, because you'll hit that 200 number ahead quickly. And then the fourth is how much cash are you running? And then there's a whole series of other things like where on the curve, et cetera. But anyway, what allows us to do is to set our investment teams free and say, okay, you have to operate. Those are the four big risks that we operate: cash, our dispersion of our beta, and our liquidity. And go do your thing and do every day. Verizon's bringing a big bond deal. Go, if you think Verizon's cheap, go do it. What you have to operate within in terms of your parameters, and then everybody comes back to the same page. Like, we know where all of our metrics are, and then we do it every single day. But listen, the one thing we'll never get wrong, you can say never about anything, but we know where all our risks are. We risk attribute every single day. We look at what happened every single day on functionally added up on every asset, and it really helps you to think about. You're not going to invest based on day to day, but boy, I want to know if there's a problem every single day. And so, like, gosh, why did credit underperform emerging markets today? And we see that in our return attribution, and what happened, and does that influence A, how you've modeled your risk, and B, how you should adjust to the market? So anyway, I'm super, super proud of if you saw our dashboards, you'd probably laugh because there's so many charts and graphs and pieces of data on it. And it's probably why I'm wearing glasses now, because I've blown my eyesight out. But anyway, it's usually helpful, and really gets us into understanding, where you're running stress tests. Literally, we run stress tests every single day, and understand what your downside is. And then, quite frankly, when you have days like March of this past, not this year, but of last year, by the way, then you got to say, okay, the model's not working, and so now what do you do, and how do you react? And but have a base starting point, and understand what's happening every day is hugely critical for us.
Okay, that's perfect. Yeah, so maybe we can kind of transition to be a bit more forward looking. And thinking about a quote that was said to me early on in my career, and thinking about technicals win the battle, but fundamentals win the war. And thinking about how we are and where we are in the cycle, and thinking about the cyclical forces that are certainly ever present each and every day, shifting to go against some of the secular disinflationary forces that we've seen over the past couple of decades. I'd love to get your thoughts on kind of cyclical versus secular, and how you construct the portfolio through that perspective, and maybe get your take on where you're seeing the most value given some of the cyclical forces that we haven't seen in quite some time.
That's a great question. So, listen, I mean, I think the technicals. So, how would I say this? The secular technicals are the most important thing to me. Does that make sense? So for example, like, I think the demographics are, like, somebody said to me, I can't trade demographics. I, if you're a day-to-day trader, I totally get that. If you're investing, the demographics, potential growth levels, what the Fed has to do, potential inflation, those, technology evolution, those are, to me, in the core of your portfolio. Those secular technicals, is that all right? Is that right? Are, the demand for income we're seeing today. That thing is epic, and I think you have to, at the end of the day, I think your core of your portfolio has to be aligned to that, and then obviously the fundamental analysis, intro all these markets and what's happening, I think is absolutely critical. And then it's, we follow the technicals on each market, incredibly closely. And, but our teams tend to do that. I would say at the portfolio level, I don't do that as much, but our teams tend to look at, for example, who needs to buy 30-year notes, or there's an auction coming, or the Fed's going to issue this amount, or the Treasury should say it's going to issue X amount or not. And so anyway, it's a blend of all those things. So where does that leave you today? Listen, I think the most, to that point, the most underlying theme is you need yield. The world needs more yield, and there's not enough yield available relative to what people need. And as the aging demographic plays out, with the thing we start with in our portfolios, like, how do we get yield? How do we get yield? How do we get yield without taking too much beta risk? Is, I think, the really, really big thing today. So what's happened in the last few months? The Fed's taken out, and the ECB's taken out all the high quality asset value. So treasuries, not very interesting. Agency mortgages, not very interesting today. The front end of the investment grade credit market, unless you're a short duration fund, not very interesting today from an upside. So where is there yield, and how do you keep your liquidity and your beta in a good place? So, credit, the loan market, still nice yield to clip, and not having to worry about duration. I'd say high yield bonds are still okay, although I think less interesting. The securitized markets, like people in the world we were talking about earlier about social media, and you hear like commercial real estate is a disaster waiting to happen. I don't know. There's lodging, there's warehouse financing, there's multifamily. I think people think there are parts of like warehouse financing is really attractive. Resi financing is really attractive today in non-agency space. So I would say securitized. We're picking away a little bit on emerging market hard currency, which has gotten really hurt recently with with rising real rates. So we're picking away at that, and I think there's an opportunity there. We're running a higher level of cash than we normally do, and part of it is we're running more of this barbell, and because duration, always look at what's the hedge, what's your parachute. Usually interest rates are your parachute. It's not today, so we're running a bit more cash than we normally run, but then but then getting yield from some of these other places that are interesting, and kicking out the assets that we think have no convexity to the upside, like parts of the agency mortgage market now. So that's how we're doing it.
That's perfect. Yeah, so that kind of does it for the questions I had. I certainly want to thank you for your time, Rick, to discuss the strategy, investment process, and really kind of the competitive advantage that our clients have by allocating to the SIO fund. We certainly value our partnership with BlackRock, and really look forward to speaking again sometime soon.
Thank you very much. Thank you. Thanks for having me.
Hey, Joe. Great job getting Rick to step away from CNBC and Bloomberg to appear on Align Spotlight.
Yeah, it was great to get Rick on the calendar. Happy he could join us, and it's a really great conversation. Had a lot of fun doing it.
Great. I think our listeners will appreciate his insight on risk, portfolio construction, and where he's finding relative value across the fixed income landscape. They'll especially find his explanation on how he analyzes portfolio risk on a day-to-day basis interesting. So maybe how do you think our FAs should be using a fund like BlackRock SIO across the fixed income allocation?
Yeah, thanks, Jason. That's a great question, and one, quite frankly, that often comes up. So when we're building fixed income allocations, we want to be cognizant of the balance across fixed income risk factors. Two top of mind risk factors that we want to be aware of are, of course, duration and credit, and really kind of think about how much we're getting compensated through yield for exposure to those risk factors. And so we don't want to be egregiously taking on too much risk to get that incremental income, but we want to be balanced, in terms of each strategy across the allocation having a purpose. And so when it comes to the Strategic Income Opportunities Fund, I really think this fund and its disciplined, risk-focused process is best used as a diversified source of income that offers an enhanced yield profile, really has a flexible mandate, allowing for exposure across the entire fixed income universe, and has limited correlation to some of the more traditional fixed income subsectors that you're going to find across high quality indices like the U.S. Aggregate Bond Index. And so the team is also incredibly has incredible depth. With Rick certainly leading the team, but maybe something that was missed during the episode, was the supporting cast on the fund. Co-portfolio managers Bob Miller and David Rogel, joined the strategy in 2011 and 2017 respectively, and are incredibly talented in terms of their own respects to the strategy. With Bob Miller, spending close to 2 decades at Bank of America before coming over to BlackRock, and helping Rick really set the macro tone to the fund, and having that tone kind of spill over to thematic positioning across the strategy. David Rogel has been on the fund and at BlackRock since 2006. Rose up through the ranks as an analyst, and he's largely tasked with the day-to-day management of the fund. He's really been an incredible addition to the team. But in terms of how our team thinks about assessing a strategy like this, I mentioned before, we're taking a balanced approach in terms of the fund's exposure to risk factors. So when you peel back the layers of performance, and you peel back the layers of what's contributing to the risk profile of the strategy, it's really quite different relative to that Bloomberg Barclays U.S. Aggregate Bond Index. What we find is, when you look at that risk profile, a material amount of the Bloomberg Barclays U.S. Ag Bond Index, that risk profile is largely driven by rates, versus spread or corporate credit. So, thinking about, historical times where rate volatility has been quite elevated, you think about the first quarter of last year, the first quarter of this year, they're really perfect examples of that in terms of rates driving the performance more so than spreads widening or tightening. We think there's an inherent advantage in terms of finding managers that have, an expertise in terms of evaluating credit, evaluating and generating alpha through security selection and sector allocation, while also taking a tactical approach to duration, to liquidity, and to regional exposure across the world. And so what this strategy looks to do is maintain that diverse approach, not just to market weighting across the portfolio, but when you dig a bit deeper, we really see a diverse set of contributors to the fund's risk. So, whereas, the ag is largely, looking at U.S. interest rates and U.S. spreads, this particular strategy, has contributors from global interest rates. So, here in the U.S., but also abroad, non-traditional kind of out of benchmark subsectors like high yield, asset-backed securities, CLO structures, emerging markets, broad corporate credit. And we really think that's an inherent benefit to the end investors and ultimately putting, Baird's clients in a better position to not only enhance the total return potential and yield, but balance the underlying risk relative to more traditional fixed income risk factors.
Thanks, Joe, for that detailed explanation. But maybe digging more into the diverse yields-oriented approach that Rick and his team leverage, can you touch on the strategic income opportunities placed across the aligned portfolio and how you seek to balance its increased marginal risk with an enhanced risk profile?
Yeah, no, another great point, and something we look at and assess quite often. And so, using some of the points that were mentioned before in terms of BlackRock SIO's diversified approach, its exposure to out of benchmark subsectors that, again, help to enhance the yield, help to enhance the total return potential while not egregiously taking on too much risk. We want to balance that approach across the fixed income sleeve on the aligned portfolios. So coupling or pairing BlackRock SIO with strategies that do have a bit higher correlation to more traditional fixed income sectors, helps to, again, balance the portfolio. Of course, we want our clients to understand that fixed income, will really serve as a ballast during volatile times, during stress times. We'll look to provide some vol mitigation, but also, we don't want that to completely suppress the return potential across the fixed income portfolios. And so, including a strategy like this, a more kind of unconstrained, flexible mandate, has the ability to, again, add an uncorrelated nature to the sleeve while also enhancing the total return and yield potential.
Yeah, thanks, Joe. And, appreciate the insight with respect to the sleeve and how it's constructed to benefit Baird FAs and their clients. So really appreciate that insight, and thank you for getting such a fantastic interview together.
Yeah, sure thing. Happy to do it, and it was really fun to talk with Rick. So yeah, hopefully we have more of these to come. But yeah, it was a great time.
Well, what did you think? It was amazing to get Rick Rieder to join us for a discussion, and we hope you found his comments insightful and the after-show discussion with Joe Lorber to be useful as you build out your clients' portfolios. We appreciate your feedback as we continue to create premium content. Are there any other aligned managers that you would like to hear from? What additional content can we produce for you? Reach out to AMR and we'll be sure to respond.